Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance and find out if these companies are truly built to last or if they're just smoke and mirrors. Today we're diving into Essent Group Limited's latest report, and let's just say they've got some interesting moves to talk about, especially when it comes to their investments and how they handle risk. Before we crunch the numbers, if you are digging this kind of financial deep dive, smash that like button and consider subscribing. We break down these filings so you don't have to. And hey, for more real-time insights and to chat with fellow finance fans, join our Discord community. Link is in the description below. Alright, Essent Group Limited, a company that is all about mortgage insurance and reinsurance and more recently, title insurance. They operate in a pretty crucial part of the housing market, helping people buy homes with lower down payments. So how are they doing in the third quarter of 2025? Let's kick things off by looking at their balance sheet as of the 30th of September 2025. This is a snapshot of what the company owns and owes. Total assets crossed the $7 billion mark, sitting at a cool $7,351,999,000. That is a nice increase from the end of 2024. What is really interesting here is their investment portfolio. They've got over $6 billion in investments available for sale. That is a huge chunk of change and tells us they're actively managing their money to grow it. Now keep in mind, these are investments they can sell if needed, which is important for liquidity. Their liabilities are sitting at about $1.6 billion, which includes reserves for losses and expenses. They also have close to $500 million in senior notes due in 2029. This essentially means they've borrowed a significant amount of money and they've got to pay interest on it. On the flip side, their stockholders' equity is a healthy $5.7 billion, showing that the owner's stake in the company is substantial. This means they have more assets than liabilities, which is a good sign. Now let's talk about what really makes a company tick, their income statement. For the 3 months ending the 30th of September 2025, net income was $164.2 million. That is a bit lower than the same period in 2024 when it was $176.1 million. But look at the 9-month period from January to September. Net income was a strong $534.9 million, down slightly from $561.5 million in 2024. While a slight dip might seem concerning, it is important to see the full picture. Net investment income is up, which is a positive sign. They're making more money from their investments. However, the provision for losses really jumped. This means they're setting aside more money to cover potential future claims, which could signal either more risky business or just a more cautious approach to risk. Cash is king, so let's look at their cash flow statement for the 9 months ending the 30th of September 2025. They generated a hefty $26.9 million from their operations. This is the cash they made from their core business activities. However, they used a significant amount, $554 million, in financing activities. This large outflow was mainly due to buying back their own stock under share repurchase plans. They also used $12.9 million in investing activities. This means they are actively investing in their future, but also spending quite a bit from their cash reserves. It paints a picture of a company actively managing its capital, returning some to shareholders through buybacks, and investing in its operations. Let's zoom in on those investments. This is where a big part of their financial health and strategy lies. As of the 30th of September 2025, their investments in fixed maturities available for sale were valued at nearly $5.5 billion. That is a lot of bonds. They also have over $640 million in short-term investments, giving them pretty solid liquidity. What is really crucial is the breakdown of these investments. A significant portion, about 31.7%, is in corporate debt securities, and they're all investment grade, which is good. They also hold a substantial amount in US agency mortgage-backed securities and asset-backed securities. This composition shows they are looking for yield while managing risk. This is a critical section for any insurance company. The reserve for losses and loss adjustment expenses is essentially the money they've set aside to pay out claims. As of the 30th of September 2025, this reserve stood at over $397 million. What is really interesting is the trend of prior year development. They experienced favorable prior year development, meaning they ended up paying out less for past claims than they originally estimated. That is a good thing, indicating their initial estimates were perhaps a bit conservative. However, the provision for losses and lie themselves increased, especially in the mortgage insurance segment. This suggests they are anticipating more claims from recently insured loans, likely due to the aging of their loan portfolio. The provision for losses and lay increased to $44.2 million for the 3 months ending the 30th of September 2025 from $29.8 million in 2024. Now, let's glance at earnings per S-Hair. For the 3 months ended the 30th of September 2025, basic EPS was $1.69 and diluted EPS was $1.67. For the 9-month period, basic EPS was $5.35 and diluted EPS was $5.29. These numbers are slightly down from the same periods in 2024, which aligns with the slight decrease in net income we saw earlier. It is not a dramatic drop, but it's a trend worth watching. Now, let's dive into management's own perspective. They're highlighting that mortgage interest rates remain elevated, which is impacting home buying and refinancing. This means fewer new loans originate, which affects their new insurance written, or NIVA. Higher rates are also boosting their net investment income. It is a bit of a double-edged sword. They also talk about Hurricanes Helene and Milton from late 2024 and how they've adjusted their reserves. They seem to be managing these natural disaster impacts prudently. They mention that the provision for losses jumped significantly. And this is partly due to an increase in the number of defaults and a higher reserve per default as their portfolio ages. This is a standard cycle in mortgage insurance, but it does show increased claims activity. Let's talk about how Essent handles market risks. They're exposed to interest rate changes which can affect the value of their investments and also influence borrower behavior like prepayments. An increase in interest rates can decrease the value of their bonds, but it also increases the income they earn from new investments. They manage this by looking at the duration of their investments. As of the 30th of September 2025, the effective duration of their investments available for sale was about 4 years. This means a 1% shift in interest rates could move their investment values by about 4%. They also monitor concentration risk and prepayment risk. This shows they're not just passively holding investments, but actively trying to protect themselves from market swings. No corporate report is complete without a good dose of risk factors. Essent is clearly navigating a complex environment. They're keeping a close eye on changes in Fannie Mae and Freddie Mac, the GSS, as any shifts in their operations could significantly impact Essent. Maintaining their eligibility with these GSS is critical. Competition is also a major concern, and they worry about lenders finding alternatives to private mortgage insurance or an increase in government-backed programs taking market share. They are always concerned about the uncertainty of their loss reserve estimates, which is par for the course in the insurance industry. Looking at share repurchases, Essent has been active during the 3 months ending the 30th of September 2025. They bought back over 2 million shares, spending about $122 million. They have significant room for more repurchases under their current plans, signaling confidence from management and a desire to return value to shareholders. So, what is the overall story here? Essent Group Limited is a well-established player in the mortgage insurance space, and they've expanded into title insurance. Their investment portfolio is substantial, and they're actively managing it to generate income and manage risk. They've seen a slight dip in net income compared to last year, but this is largely offset by strong investment income growth and a solid grip on their expenses. The biggest challenge appears to be managing the increasing provision for losses in their mortgage insurance segment, a natural consequence of an aging loan portfolio and rising default rates. They're actively repurchasing shares, indicating management's belief in the company's value. Their strategy of expanding their investment portfolio and managing interest rate sensitivity appears sound. However, this reliance on interest income and the increasing pressure on their loss reserves are key areas to watch. The competitive landscape driven by GSEs and alternative insurance products remains a constant challenge. In essence, Essent is navigating a dynamic market with a mix of solid performance and some increasing headwinds, particularly in the core mortgage insurance business. They are strategically reinvesting and returning capital to shareholders, but the rising default numbers warrant close observation. What do you all think about Essent's financial health and their strategies going forward? Let me know your thoughts in the comments below. If you found this breakdown useful, please give this video a thumbs up and make sure you subscribe for more in-depth corporate analyses, and don't forget to join our Discord community for more discussions and insights. We'll see you in the next one.